2006 has been a great year for Australian equity market investors. The market's going to finish the year 20% higher than in January. Dividend yield being paid is about 3.6%. There has been a raft of takeovers, both by the private equity world and the corporate world, and it really has been an unprecedented year of returns in large cap companies. The year ahead will be a very interesting year. We have slight headwinds of oil prices and interest rates, but they were the same headwinds we had in 2006. 2007 to me looks like a very interesting year. I expect more M&A activity. I think we're all underestimating the takeovers that will come in Australia. I think we're all surprised by the Coles-Myer takeover and the Eureka takeover. These are massive Australian companies being taken over, and we need to ask ourselves, why are these companies being taken over? What are these foreign investors and foreign corporates and private equity firms seeing in these companies that Australian investors aren't seeing? Well, they're seeing value. They're seeing oligopoly industry structures. They're seeing cash flow, and they're seeing balance sheets in Australia that have never been in better shape. The simple fact remains that while 2006 was a great year for the Australian equity market, all that happened was stocks went up in line with their profit growth and dividend growth. We have seen no PE expansion to reflect the fact that Australian companies are in the best financial shape ever, and we've seen no PE expansion to reflect the unbelievable balance sheet strength we now have. I believe we're going to see more and more takeover activity in Australia, and 2007 will be the year where the PE of the market actually expands to reflect this takeover activity. In 2007, I expect the PE of the market to expand. I believe this will take the index with it, and I believe the ASX 200 index will move to 6,000 as the year progresses. That'll deliver about a 10% capital gain to investors over the year, and I expect the dividend yield to be about 3%. But we've got to look for ways of doing better than that. I think there's many companies we can find we will be able to generate a better than 10% capital gain while also yielding more than 3.5% along the way. Now, I believe that the first place to look is for high fully franked dividend payers. I am a massive supporter of fully franked dividend streams. The Australian superannuation and taxation system rewards investment in fully franked dividend streams. One of the key things we look for and recommend is assured fully franked dividend streams. Clearly, the banking sector has that. I also believe Telstra has that, and I think T3 will be a success. I believe through time that the dividend of Telstra will be maintained, and the market is too pessimistic on the outlook for Telstra. Telstra could be one of the great bargains of the next 10 years if they can maintain the dividend, because the fully franked dividend stream there is very valuable. So the first place we look is for fully franked dividend yields and whether they are sustainable. With the rise in the influence of hedge funds and trading in the broking community, you do get very, very big periods of volatility. The volatility in the market now is the greatest I've ever seen. You very rarely get a day where the index is flat. Leading shares move around 1 or 2% a day. I remember when I first started, leading shares moved around 1 or 2% a month, if that. And the volatility is unprecedented. I would encourage you not to be scared of volatility. Volatility is an opportunity and something we have to all get used to now. In periods of excess volatility, the natural reaction of people is to go and hide under the bed. That is not the right response. In highly volatile periods, when it seems like the world's ending, and high-quality shares like the Commonwealth Bank or BHP or Rio or St George or the AMP or Lendlease, these big, great Australian companies are getting knocked around for a reason that really is out of their control. You must be brave. You must stand up. You must accumulate these shares in those periods. When you see the whites of people's eyes, you must be in the market acting. And it's completely contrary to what most people see as the normal way to respond. The best investors I've ever dealt for or ever worked for have always looked to the future. They haven't looked to history for their guide to how they invest. History paints you some sort of picture of, what has happened. But share market investing is all about the future. You must keep looking forward. Do not look in the rear vision mirror. Look forward. As I say sometimes in the notes, I say, a lot of people try to negotiate the share market by driving the car forward by looking in the rear vision mirror. We won't make money behaving like that. I encourage you to look forward. You must be an optimist too. To do well out of the share market, you must be somewhat optimistic. Doesn't mean we're wildly optimistic, but you must be somewhat an optimist in the future. As we sit here today, the Australian economy is in unbelievable shape. We have basically no unemployment of any note. Everyone who wants a job has a job. Government's got an unbelievable balance sheet themselves. They really have no government debt. Government's got an excess capital position. Australian companies are in unbelievable shape as well. People would say, Charlie, it's good as it gets. No, it's not as good as it gets. We're in a very strong position, but our companies are not priced for speculation. Our companies are not expensive. The average PE is about 14 times. The average dividend yield is about 3.5%. That is not expensive. I expect to see that PE to expand this year, coming in 2007. I expect payout ratios to increase, and I think investors with a medium-term time frame in strong Australian companies will do very well again.